2 consecutive quarters of negative growth. By the textbook definition, that is a recession. Statistics Canada just printed the numbers. Q1 down 0.1% annualized. Q4 of last year revised down to -1%, and yet half the economists in this country are telling you it doesn't count. So what is it, Dan? Are we in a recession or aren't we?
We're going to give you the actual numbers, the actual definition, and more importantly, what every single one of you listening should be doing with your portfolio right now before the Bank of Canada meets on June 10th.
Welcome back to the Canadian Real Estate Investor. I'm Nick Hill, mortgage agent and real estate investor, and as always, joined by my friend and podcast co-host and a bit of an economist himself, Daniel Foch. You have actually been calling the housing recession, or the recession in general, for quite some time now.
Yeah, maybe a little bit too long. I'm glad to be back, and I want to say up front, I'm not here to gloat about my recession call because I was definitely early, and also, like, you know that "Don't Dance" scene in The Big Short, right? Like, nobody wins. Wow, it only took you 2 minutes
to bring up The Big Short in this episode.
Nobody wins when the economy stalls, especially not real estate investors. But in this, in this episode, I think that it's important because the data dropped on Thursday, right? So Statistics Canada, Thursday, May 29th, and the framing in the media has been all over the map. Even like politicians' comments, which we're going to go through, all over the map.
Yeah, I mean, it's weird because I think we've been talking about this for, with your kind of official calls and us covering the data for literally over basically 4 years now. And, at first it was the vibe session, and now we're just kind of like, okay, well, you're inflating numbers to make it not look like we're in a recession, but we kind of are. Everyone can kind of feel it. But now you've got like the likes of CBC saying, yeah, you've got a technical recession. You've got BMO saying, well, maybe not quite. You've got RBC saying actually a per capita things are getting better for some. And then you've got CD Howe, who are basically, Canada's official recession callers, right? We did that little piece on the people over at CD Howe that get to ring the bell for a recession or whatever. They're saying they're not ready to fully call yet. So it's such a mixed bag of stuff out there, as it always is. For me, it would be really nice just to finally admit and for everyone to agree that, whether we like it or not, whether we care to admit it or not, we are definitely in a recession and probably have been in one for a little bit. And I think the faster we can face that, the easier it is going to fix that problem. I hope.
Yeah. Yeah, 100%. So 4 segments in today's episode. 1, what the print actually said and what technical recession really means. 2, what's driving the slowdown, because the headline number hides a pretty interesting story. And there's a lot of commentary in the StatCan thing about housing and housing investment. Number 3, what does this do to the Bank of Canada's path? Because the swap market is doing something genuinely weird right now, and the bond yield curves are doing something weird as well. And 4, the part you actually care about, what does this mean for you, your portfolio, your mortgages, your real estate deals?
Yeah, and as always, just with these kind of episodes, it's not financial advice. This is 2 guys that love housing, love the economy, and being investors that try to help you out by giving you information. Talk to your own advisor, build your own thesis, do your own numbers, but then engage your power team, right? Talk to a guy like Dan, talk to a guy like me, or your mortgage agent, your realtor, your wealth advisor. Do your own due diligence, all right? Dan, let's get into it.
Yeah, so before we get into the print itself, I want to ground new listeners and remind the regulars of the story that we've been telling on the show for about a year and a half now, because none of this was a surprise. The data caught up to, and Carney even said that. I think Carney said, like, when they asked him about the weakness in the recession, he was like, it's population growth. And it's like, okay, so our GDP has been propped up by population growth for the last several years. Like, we weren't false in that. But the data caught up to a setup that was already in place. Like, we have, and Canada's, I think, one of only 6 countries in the world that's in a technical recession right now. The other are like all emerging markets, right? Third world countries for the most part.
Yeah.
And
I believe, as the young people say, we have the receipts to prove it.
Yeah. So we're in this like made in Canada recession that nobody else in the world is in a recession yet. like in the West, in the developed world. They probably will get there, but we're leading the charge, which doesn't give the Bank of Canada a ton of room to do much because they don't want to cut ahead of the Fed, right? And it's a messy setup, man. It's a very similar setup to the 1990s, which again, not to gloat, but I think we said that it was a very similar setup to the 1990s. Anyway,
insane.
Talk to me about the Bank of Canada.
Yeah, I mean, let's run the tape here, okay? Paint a bit of a picture. Late 2023, the Bank of Canada is sitting at 5%. Inflation is finally coming down. Housing is essentially frozen because no one could carry a mortgage at that rate after everyone was getting rates in the ones and twos. And the pre-construction market has started to collapse and show some serious systemic problems.
And 2024... rate cuts begin. The Bank of Canada takes us from 5 down to 3 over the course of a year. Variable mortgage holders can start to breathe again. We start to see signs of life in the housing market, but never really a real recovery.
Late 2024 into early 2025, we all remember the U.S. elections, all the tariff stuff, the tariff threats and the drama. Then, of course, the actual tariff implications. The Canadian auto sector directly hit. That had impacts on markets. Canadian energy gets caught up in the price volatility. Business investments started pulling back and exiting Canada altogether. Nobody wants to build or invest in someone where trade rules are changing every 6 weeks, and there doesn't seem to be support for small business endeavors right now. And
then you had 2025. You had the population policy shift. So Canada actually starts to see net outflows in certain quarters, and in the annual basis, headline GDP gets dragged down, even though per capita is fine, which is the opposite of what we saw during the population growth period, right? GDP per capita was getting crushed. GDP was ripping because the population was growing like 4% in a couple of years there. So the Bank of Canada continues cutting through the back half of 2025, gets us to 2.25 by year end.
And then another wild card, right? Oil prices spike, geopolitical instability, things get really hectic. Horrible things start to happen. Inflation expectations re-anchor higher. The Bank of Canada, which had been, kind of on a cutting and holding path, things were seemingly, there was a slow path out. Well, this all changes due to this global stuff that, of course, no one has any control. Well, not no one, but most people don't have any control over. Pauses it in early 2026. April 29th, they hold at 2.25%, and here we are, Dan.
So when you see the Q1 2026 print and people are surprised, they shouldn't be. This is exactly the kind of stalled, sideways, frustrating economy that comes out of an 18-month period when trade uncertainty plus monetary tightening plus a population transition plus an oil price shock. Like, nothing about this is sudden or surprising.
Yeah, it's really that kind of boiling water effect, but there's just, 8 different pots of boiling water that are slowly getting turned up. And look, I mean, the political sprounce, finally kind of confirms the read. Prime Minister Carney called the print, and I'm quoting here, settling in a period for the government's economic plan. He pointed directly to the immigration cuts that you mentioned, Dan, that have flattened population growth, and that the fact that they've taken government spending growth from close to 10% to down under 2%. That is a massive swing. That's not the language of a government that thinks the wheels are coming off. That's a government that's kind of saying, yes, this is what we did, and we did it on purpose, which, remains to be seen.
Well, I mean, if they did, which I think, again, they did contract spending. We talked about that, when we were originally discussing the idea of austerity and shrinking government spending and even comparing the budgets. They did decrease population growth. If they were deliberate and okay with the outcome being a recession, I actually don't mind that, because I think it's necessary. I always use this term economic Darwinism, right? Like survival of the fittest, bad business models, bad investments, bad businesses, whatever. We shouldn't promote an economy that allows those things to survive. Things that were going to die should die. That's how it's always worked in nature. And I think that totally the economy agree. Is just nature with numbers on top of it. So on the Bank of Canada side, Senior Deputy Governor Carolyn Rogers said something similar, but really important the day after the print. She acknowledged the 2-quarter definition has been met, but she said, quote, the economy most likely rebounded in April. And that's the central bank basically telling us that they think that Q1 or this period was the trough. And I will caveat that with like, of the last 5 quarters, we've seen technically 3 quarters of negative GDP growth, right? Q2 of last year, Q4 of last year, and then Q1 of this year. And when I like make the comparison to the 1990s, you didn't see like, it wasn't like 4 years of declining GDP. It was like down, up, down, up. And I think that that's more painful for Canadians, because if you get a deep V, like a deep V-shaped recovery, then like a deep recession, then Canadians, like the central bank jumps in, the government goes and spends a bunch of money, and they try and stimulate their way out of the economy. If you get up, down, up, down, up, down, then it's bleeding people out. And that's what Canadians can't afford right now. Time isn't on our side. We have interest rates resetting at higher rates. We have a lot of people cash flow negative, a lot of people bleeding out on their monthly mortgage payments. I think that's actually a worse outcome than a deep recession, personally.
I completely agree. I mean, the way that you just described it, I think it's the unknown that is, you add that factor in there of when is this going to get better? It might get better for, a month, a 2-month period, and then it might get worse. And overall, inflation and all these other things are still happening. All these prices are going up, and it sucks. In layman's terms, the whole thing sucks. But it also shows that the economy isn't like breaking right now. It's that grind which we've talked about and done so many different episodes over the years that kind of contribute to this grind, whether it be episodes on inflation, on mortgages, on immigration, on top earners leaving, on how hard it is to invest or make numbers work. Now, listen, with all that being said, and with that kind of official framing around it, let's actually get into the print itself. So let's start with the numbers. Statistics Canada, Thursday morning. What did the GDP print say?
2 numbers to take away from this. Q1 2026 real GDP on an annualized basis fell 0.1%. On a quarter-over-quarter basis, it was the unannualized number. It was flat, basically like 0.0.
Huh. Okay. And the prior quarter?
Q4 of 2025 was revised down. It now sits at -1% annualized. And that's minus 0.2% on a quarter-over-quarter basis. So both quarters annualized were negative. That is the textbook 2 consecutive quarters definition of a technical recession.
Okay, so there we have it. So the news headline saying Canada slips into technical recession, they're not wrong. That is literally exactly what the data is telling us. And Dan, I think you and I have realized that, years of doing the show and underwriting deals and everything, numbers speak louder than words sometimes.
Correct. But here's where it gets fun, because there are actually like 3 different lenses that you can look at this through, and they tell you 3 different stories. So 2 consecutive quarters of negative annualized GDP growth. Yes, we have that recession by definition.
Yeah, so CD Howe runs the Business Cycle Council. They're Canada's kind of, again, unofficial recession arbiters. Basically, the closest thing we have to like the US NBER. And their CEO, Jeremy Cronick, came out Thursday and said, quote, "At this point, I would not be ready to call a recession." Interesting.
Yeah, and we talked about how they sort of make these calls. Like, their framework looks at depth, breadth, and duration. A 0.1% annualized dip in a flat quarter, it's not like a deep recession, at least not yet. It could be. But by their framework, no, this is not a recession yet. And the big bank chief economist landed in the same place. Scotiabank's Derek Holt said, quote, "It would be irresponsible to make a recession call on the basis of surging gold imports," as an example.
BMO's Doug Porter pointed straight at the federal government, saying the weakness was, quote, "largely driven by a surprise decline in government spending and investment," which is pretty different, a pretty different read than the economy is rolling over. And that there's also the lens that I think is actually the most interesting one, which is what RBC's Nathan Jansen and Claire Fan have been hammering on, and that is per capita GDP.
Claire's the one with the RBC 10-minute take podcast, right? I listen to that a lot, actually. It's good. But this is the wild one.
Claire, like, if you're listening, Claire, you're welcome.
Yeah, I've asked
to join
them
us
to come on the
here.
show, but yeah. This is the wild one. Like, the headline GDP was flat in Q1, but Canada's population also declined in Q1 for the second consecutive quarter. So on a per person basis, GDP actually rose, right? So remember we went through that long period, and I'm really interested to see what happens here, because for like the last 3 years, they're saying GDP per capita is crushing Canadians. Everyone feels like they're in a recession. And everyone in that camp was like, oh, that's not a good measure. and I'm curious to see now if it's increasing, if all of a sudden it becomes a good measure. But because it seems to be the case, right? Like, it was like,
of course,
what was the gas price or the carbon tax? It was like, oh, it's not inflationary. And then when they got rid of it, it's like, oh, look at all the deflation we created. It's like, what?
Guys,
anyway,
please. Yeah, I mean, look, so in the most literal sense, the average Canadian was a little bit better off at the end of Q1 than they were at the end of Q4. And the ironic thing, that is the opposite of what a recession feels like, right? So this is where the numbers get different. Yeah, it's weird.
Well, especially like if the business environment is contracting in Canada, then like you might actually feel like a worsening. But if population growth is like the headline number is being pulled down by population shrinking, and the population shrinking because of immigration policy changes that started kicking in last year. So you're looking at a country where the economy is roughly flat, but the pie is being divided among slightly fewer people.
Yeah, I mean, it's totally true. I mean, look, from the mortgage side of things and some of the things